Is gold about to hit a staggering $5,000 an ounce? A major Swiss bank thinks so, and they believe it could happen much sooner than you think. We're talking about a potential timeline of early 2026. This isn't just a wild guess. It's a detailed forecast from UBS, one of the world's leading financial institutions. Today, we're going to dive deep into exactly why they're so bullish on gold. We'll break down the 4 key drivers behind this prediction, explore what it means for the broader commodities market, and discuss how this could impact your own investment strategy. If you've ever considered buying gold or are just curious about where the global economy is heading, you're going to want to stick around for this. So, let's get right into the headline number: $5,000 per ounce for gold. According to Dominic Schneider, a top analyst at UBS Wealth Management, this isn't a matter of if, but when. Their latest forecast points to gold hitting this monumental price by the end of the first quarter of 2026. That's just a little over a year away. But what's fueling this incredible rally? It's not just one thing, but a powerful combination of factors all coming together. First up, and perhaps one of the most significant drivers, is central bank buying. For the past several years, central banks around the world, particularly in emerging markets, have been on a gold buying spree. Why? They're looking to diversify their reserves away from the US dollar and other fiat currencies. Gold is seen as a stable, reliable store of value that isn't tied to any single country's economic policy. This consistent, large-scale buying creates a strong floor for gold prices and provides a steady source of demand that isn't going away anytime soon. As geopolitical tensions rise and questions about the long-term stability of the dollar persist, this trend is only expected to accelerate, pushing prices higher. The second major factor is growing fiscal deficits, especially in the United States. Governments are spending more money than they're taking in, leading to massive amounts of debt. To fund this debt, they often print more money, which devalues the currency. When your dollars, euros, or yen buy less than they used to, hard assets like gold become much more attractive. It's a classic hedge against inflation and currency debasement. With government spending showing no signs of slowing down, the appeal of gold as a way to preserve wealth is stronger than ever. Investors are looking at these mounting deficits and seeing a clear reason to move a portion of their assets into something tangible and historically proven. Third on the list is the expectation of lower U.S. interest rates. Gold has a unique relationship with interest rates. Because gold itself doesn't pay any interest or dividends, it becomes more attractive when interest rates are low. Think about it. If you can earn a high, safe return from a government bond, you might be less inclined to hold gold. But when interest rates fall, the opportunity cost of holding gold decreases significantly. The Federal Reserve is widely expected to begin cutting rates to support the economy. Lower rates make the US dollar less attractive, which in turn tends to push the price of gold, which is priced in dollars, higher. This inverse relationship is a fundamental dynamic in the gold market. And the fourth key driver: ongoing geopolitical risks. From conflicts and trade disputes to political instability, the world seems to be in a constant state of uncertainty. During times of turmoil, investors flock to safe haven assets, and gold has been the ultimate safe haven for centuries. It's a physical asset that holds its value when paper assets and currencies are in question. We saw this play out recently when news broke about the U.S. ousting the former Venezuelan president. Gold prices jumped immediately. Any unexpected event can send a shockwave through the financial markets, and in those moments, gold provides stability and acts as a form of financial insurance. Given the current global landscape, it's safe to say these risks will continue to be a major tailwind for the gold price. So, UBS is forecasting gold to rally to $5,000 by March 2026, stay at that level through September, and then moderate slightly to around $4,800 by the end of the year. It's important to note that this is a significant upward revision from their previous forecasts. They've essentially added $500 to their year-end target, which shows just how much their conviction has grown. They even suggest that if political or financial risks escalate further, particularly around events like the U.S. midterm elections, gold could even spike to as high as $5,400 an ounce. But this story isn't just about gold. UBS sees this as part of a much broader commodities rally. They retelling investors that commodities are set to play a much more prominent role in portfolios in 2026. This is based on fundamental supply and demand imbalances across the board. For example, they see huge opportunities in industrial metals like copper and aluminum. Why? The global energy transition, the shift to clean energy, and the electrification of everything from cars to heating systems requires a massive amount of these metals. Think about all the copper wiring needed for electric vehicles, charging stations, and upgrading power grids. Demand is soaring, but supply is struggling to keep up. Mines are difficult and expensive to start, and existing ones are facing declining ore grades. This supply shortage is expected to push prices for copper and aluminum significantly higher. It's a similar story in agriculture and even crude oil. For oil, UBS expects prices to recover in the second half of the year. They believe the current surplus will disappear as global demand remains solid and supply from non-OPEC Plus countries starts to slow down. This creates a tight market where prices are likely to rise. Essentially, we're re-entering a period where the raw materials that power our world are becoming scarcer and more valuable. So, what does this all mean for you as an investor? Hub suggests that in this environment, a portfolio allocation of up to 5% in a diversified commodity index could be a smart move. This allows you to gain exposure to the upside potential across the entire complex, from energy and metals to agriculture. It's a way to diversify your portfolio away from traditional stocks and bonds and protect against shocks like inflation or geopolitical events. They specifically highlight a preference for broad commodities exposure, gold itself, and even select commodity-linked equities, which are stocks of companies that mine or produce these raw materials. Let's recap the main takeaways. UBS has put out a bold call for $5,000 gold by early 2026. This is driven by a powerful combination of massive central bank buying, ballooning government deficits, the prospect of lower interest rates, and a world filled with geopolitical uncertainty. This isn't happening in a vacuum. It's part of a wider super cycle in commodities, with industrial metals like copper and aluminum also poised for significant gains due to the green energy transition. The message is clear. The era of cheap, abundant raw materials may be coming to an end, and investors who position themselves accordingly could see attractive returns. Of course, no forecast is guaranteed, and commodities can be volatile. But the underlying trends that UBS has identified are powerful and long-term in nature. Whether gold hits $5,000 on the dot or not, the direction seems clear. The factors pushing it higher are deeply embedded in our current economic and political reality. As always, it's crucial to do your own research and consider your own risk tolerance. But the arguments for gold and the broader commodity sector are more compelling now than they have been in a long time. Thanks for watching. I hope this breakdown gave you a clear picture of what is happening in the gold market and why the experts are so excited. If you found this video helpful, please hit that like button and consider subscribing for more insights into the world of finance and investing. Let me know your thoughts in the comments below. Do you think gold will hit $5,000? See you in the next video.